Okay, so got to do a bit of a victory lap here. Victory lap for predicting bad news. So on October 13th, 2021, I believe it was this video. Uh, I did a little prediction. I said inflation would continue to be elevated. And I also said, most importantly, that GDP would be 0% or zero. It would come down to zero by Q1. And as many people know, um, GDP fell by 1.4% for Q1. So I just got to do a little victory lap here. All of the big economists and those types of people. Raoul Pal was just, inflating his ego and all that. And they're all saying they predicted it. And, with these guys, they kind of predict everything at once, it seems. So they're going to be right. They kind of switch their outlooks from week to week, day to day. And then they're right. But how many people, I wonder, how many Raoul Pauls and how many people out there besides him, all these other guys that are proclaiming their victory on predicting this, how many of them predicted this in October of 2021? I mean, I'm just saying. How are you going to get a fuck? How are you going to let a boiler mechanic out predict you, Mr. Big Economist? But I guess, he still has, Raoul Paul, for example, he still has $1 billion or whatever. So I guess I can't talk too much shit. But yeah, and then I noticed this yesterday too. They were all trying to paint this rosy picture on the numbers. They were predicting, I believe, over 1% GDP growth for Q1. And they're saying here in this article, oh, it's not so bad. It's not so bad. We're only halfway to a recession after all. It's not so bad. Calm down. So they go on here and they're saying, well, it's it's because of the trade deficit. The trade deficit grew. And if it wasn't for the trade deficit, oh well, we'd have positive GDP. But the trade, so it's just the trade deficit. Like that's not a big deal. The trade deficit, like that doesn't matter. I mean, I know they do everything they can to try to downplay the trade deficit because it's a new record every month. We have a new record of trade deficit every month. So they try to downplay it. But yeah, they said, well, yeah, because other countries aren't producing as much, and or they're no, we're not. It's that we're importing more than we're exporting, and that comes out of the GDP. And the other thing they talk about here, so that was one. They said, oh well, if it wasn't for for the trade deficit, GDP would be 1.8%. Well, maybe we should do something about our trade deficit then, don't you think? But oh no, we can't do anything about that. We're just going to use the rest of the world as our factory forever. Like that's going to work. I don't think that's going to work, especially not into the environment we're heading into. So they're going here saying, what's the other one? Inventories. Inventories subtracted 8 to 84 hundredths of 1%. Now, this is something I wanted to touch on here. So, typically when inventories start contracting, now they're blaming it on the supply shortage. But is it really the supply shortage? I don't think we've had a major problem with supplies for most of this quarter. For the most part, the supply crisis was over late last year. We might have had a few problems, in January. But really, in my opinion, is the reason that businesses are toning down on their inventories is because they feel that in the coming months and years, they're not going to be selling as much product because of the inflation. Because inflation, gas prices, energy prices are going to cut into the consumer's pocket and they won't be buying the consumer goods. So they're saying, well, that's not a big deal. And then they go on to show, hey, they're like, oh, the inventory problem tends to um, balance itself out annually. So you'll have, for example, 2 negative quarters and 2 positive quarters. So they use the last 2 years as an example. Q1 2020 negative 51%, Q2 2020 negative 4%. But the following 2 quarters it was positive. It balances out. But what happened in Q1 2020? We were heading into basically a recession, regardless of whether COVID hit us or not. That's not me saying that. That's most economists. And then Q2, we had the COVID lockdown moronic recession that we created for no reason. And then QT, we had a rebound, because of base effects, more than anything else. And then the same thing, they go here to to 2021. What did we have in Q1 and Q2 of 2021? We had the Delta variant and the associated restrictions and lockdowns associated with that, which basically sealed the deal on creating the shipping crisis that we had that lasted for the rest of the year. And then we have base effects rebounding on that. But they're saying, hey, look at these last 2 years. Look, it's no big deal because they had bad inventory. They had lower inventories on both of these years. Okay. And they still balanced out annually. But let's dig a little deeper than that because something tells me that the last 2 years, year 2020 and 2021, were not in fact were typical for inventories. So if we look at this chart here, let's go back to 2018. Now this is not as easy to read, but you'll be able to get the picture. January 2018, 1.911, February 1.918, March 1.920. We see a steady decline throughout the year, all the way up to December. Not 1 month of declining inventory in 2018. 2018 was a good year. Then 2019, we see here going up. Here we have a slight decrease between February and March of 2019. Don't remember exactly what happened there. And we see a steady increase. It gets a little stagnant right around September, October, November. And then remember in 2019, we had the repo market crisis. Okay, so that would be kind of a more rocky year, 2019. Now, if we recall, in 2019, a lot of people were talking about the economy was on thin ice at that point. And then we got 2020. So this is more I would say January 2018 is what a good year would look like. So the argument that what we saw in the last 2 years is typical and this will certainly balance out, it always does. That's a cockamamie argument. But let's also remember this. We had COVID issues that caused these negative inventory situations. What did we have in Q1 that would have caused a decline in inventory of 0.8%, which is actually, a modest decrease? The war in Ukraine hadn't really got going yet. That was late February. So what it was, in my opinion, businesses are looking at, and it wasn't the supply crisis either. The supply crisis was pretty much over by December. So my opinion is businesses are seeing gloominess and dark clouds on the horizon. They're lowering their inventories because of inflation, because they know there's not going to be any fiscal spending that's going to increase disposable income, for example. I mean, this is just off the top of my head. But that's their take on it. And then they go over here and show year over year inventories, but they don't show the fact that in 2018 the inventories steadily rose throughout the year. So 20 so this is Forbes, by the way. Forbes is a statist magazine, that a statist publication that puts out propaganda. If we recall, they did some pretty crazy articles during the COVID hysteria. So sometimes they put out decent shit, and sometimes it just depends on who's writing the articles, I guess. Some of these people are fucking CIA attaches or whatever, and some of them write good shit, But it's definitely a statist type magazine or publication. I saw an article as well from Barron's that put a lot of emphasis on personal income and outlays. So here's personal income and outlays, the latest report. And what we need to look at, if the economy's doing good, you would think that Americans would have more disposable income, correct? Well, here we have disposable personal income rose 0.3% January, 0.7% February, 0.5% in March. Now, in 2012 dollars, so this kind of corrects for inflation, that would be a negative 0.3%, 0.1%, and negative 0.4%. Of course, the article in Barron's didn't mention that at all. Are we seeing what's going on here yet with the financial media? I was talking to one guy today, very smart dude. He plays around with the market. He does trades, and he's done pretty good for himself over the last couple years. But I think he's one of these types of people that watches cable news like, CNBC or Bloomberg or whatever. And I feel sorry for what's going to happen to him for the rest of this year. And I was trying to convince him. I said, man, he seems to think that the market's going to start going up starting in the late May and going through the summer. He's not looking at the broader macro outlook and what's going on in the economy. And I just hope he doesn't get wrecked. But yeah, so my feeling on all this is we're definitely at the beginning of a recession. We're going to have negative GDP growth next month, quarter as well. Inflation is going to continue. There's nothing to stop it. We might see later on in the year, I would say we might be close to the peak of inflation, but that doesn't mean that inflation is going to fall precipitously once it passes its peak. I still tend to think that inflation is going to be elevated. Growth is going to be stagnant for the foreseeable future. What I'm really excited, well, I wouldn't say excited, but what's really interesting is watching what's going on in the bond market. I'm wondering what's going to happen. When is the Fed going to blink on this? Because bonds are just crashing. And what people don't realize is that the bond market is much more important to the overall economy than the stock market. It's got a much more money going through it. That's where companies finance themselves. And many companies depend upon bonds and selling bonds to keep running. And that's that's the whole thing behind zombie companies. So I'm wondering at what point are things really going to start crashing and burning? Because we got yields on most of the treasuries, sitting at about 3%, 300 basis points. And the Fed hasn't even stopped quantitative easing yet. They're still growing their balance sheet. I don't know what they're using some trick. So what's going to happen when they start letting those bonds roll off their balance sheet? I don't know, but it's not. I don't think it's going to be good. And when the bond market crashes and burns, now usually people say when the bond market does bad, the stock market does good, and vice versa. I don't think it's going to be that way this time, folks. I think we're going to see the bond market continue to crash. The bond market is really the leading indicator here, as it usually is, and the equities market's going to follow. Because all these companies, many of these companies, especially the large companies that are significantly are significant parts of weighted indexes like the S&P and Nasdaq, they're gonna suffer badly if they have to start paying 5, 6. Well, they're paying more if they pay whatever interest they're gonna have to pay to buy bonds, 10%, 15%. They won't be able to do it. You know, companies with good credit ratings paying 10%. Who knows? I don't know how that works, but they're going to pay significantly higher interest rates. Amazon today was talking about making allusions to layoffs. So once the layoffs start coming out, that's going to be even worse. Think about it. What if Amazon starts doing layoffs? They said they made some remark in their quarterly report that they have too many employees. They just start laying them off? That's a lot of people. How many people do you know work for Amazon? I see Amazon everywhere I go. You know, they never had a sustainable business model. Their business model was to have no profit margin so they can put their competitors out of business. That was always their business model. So I think we got rocky times ahead. And this guy I was talking to today, he's saying, well, it's going to start going up starting in mid to late May because of the summer spending habits and all that. I'm not so sure. Maybe it'll go up a little bit or flatten out a little bit, but I think the overall trend this year is going to be down, down, down. And inflation is going to remain elevated. I think we're going to have a higher print next month and maybe the month after that. And then maybe we'll decline a little bit, flatten out a little bit, jitter here and there for the rest of the year, maybe slowly trend downward. I don't think we're going below 5% year over year, but we'll see. I doubt it. And all that inflation just compounds and compounds, and it's going to eat into demand even more. And eventually something's going to break. Bond market, inflation, the equities market starts falling apart. All these people making money off of the off of stocks, they're going to have less money to spend too. Then you got companies like Amazon implying that they have too many workers. It's not looking good, folks. And then, of course, everybody's going to say, well, all we need to do is vote in some Republicans into Congress, and then they're going to fix everything, right? Is that what you think? Well, I'm here to tell you that the Republicans have no answer to the economic problems this country faces. The Republicans have no answer. Trump has no answer. The issue is the American people keep voting for either Republicans or Democrats, and that's why we're in this situation. So people have to suffer a little bit, I guess, to wake up. But so I just wanted to do this little video to do my little victory lap and give my little prediction for the rest of the year. You know, commodities might be flattening out now that I think of it. So, you know, if commodities flatten out a little bit, oil flattens out, inflation might subside a little bit. But again, it's not going to go down. So we're going to have disinflation, and that's going to sound really good to people, you know. I'm sure the media is going to start using that term. But disinflation from, we're probably going to be over 9% next month. So disinflation from 9% to 8% to 7% to 6%. You still have 6% inflation by the end of the year. So much for disinflation. Small consolation that must be. Well, at least inflation is going down. But, you never know. You may have a complete breakdown in the market and you start having deflation. Then the Fed is going to turn pedal to the metal. And that's when the dollar gets destroyed. But that's a topic for another day. So I'm out. That's it for this video.